Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Meta. Trading near 634 per share, I currently have a buy rating on Meta stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q25 results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Meta, and my conclusion on Meta's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with Meta. If you're enjoying this, please smash that like button. In 3Q25, Meta beat Wall Street estimates on both revenues and EPS, but the stock did pull back due to concerns regarding increased spending on AI. Let's cover the red flags first. Meta told investors bluntly, next year's costs are going to increase even faster than this year.
Sounds expensive.
When a company admits its bills are about to surge, it means that profits get squeezed and shareholders eat the risk.
As a result, our current expectation is that CAPEX dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth primarily driven by infrastructure costs, including incremental cloud expenses and depreciation.
New privacy rules are weakening Meta's ad targeting. This is sand in the gears of their cash engine. If targeting weakens, advertisers spend less and Meta's core cash machine suffers. If a company studying its own product finds harm and shuts down the research, it raises serious reputational and regulatory risks. Investors may be underestimating future legal liabilities, fines, or regulatory crackdowns that could hit Meta's valuation hard.
Internal documents showed people who stopped using Facebook for a week reported lower feelings of depression, anxiety, loneliness, and social comparison. Rather than publishing those findings or pursuing additional research, the filing states Meta called off further work and internally declared that the negative study findings were tainted by, quote, existing media narrative around the company.
U.S. senators say that Meta is running obvious scam ads across Facebook and Instagram and making money from them. If regulators act, Meta could face major fines, forced refunds, and tougher oversight that hits future revenue.
Good night, scammers.
Meta's Llama, its core AI model that powers Meta AI tools, is testing weaker than ChatGPT and Google's Gemini. If Meta's main AI brain isn't as strong as rivals, all that massive spending may create weaker rollouts that users don't want.
Now, look at where Meta has been. It's been a bit of a roller coaster. It went from leading a key field of AI with Llama, one of the most capable open source models on the market when it launched, to now really just chasing the pack. Product launches, hiring sprees, newer Llama models that have fallen behind their Chinese counterparts. This is where we are now, and as a result, investors are losing faith. Meta shares over the past 3 months, they have massively underperformed the other mega caps markets. They're rewarding players that are selling basic AI services today, like a Google has really been able to show.
A Spanish court ruled that Meta abused user data and now owes media outlets more than $500 million. If this sets a precedent, then Meta could be staring down billions more in fines throughout Europe.
Justice.
Here's what got me really excited. Meta's core ad business is still a cash volcano, blasting out double-digit growth even while spending explodes. When revenue outruns rising costs, it proves Meta's business model is still strong enough to fund its AI vision.
Q3 total revenue was $51.2 billion, up 26% or 25% on a constant currency basis.
More people are opening Meta apps every day, giving the company more eyeballs, more ad slots, and more monetization control. When user growth is still rising at Meta's size, it shows that the platform isn't losing relevance, it's tightening its grip.
We had another strong quarter with 3.5 billion people using at least one of our apps every day. Instagram hit a major milestone with 3 billion monthly actives. And we're seeing good momentum across our other apps as well, including Threads, which recently passed 150 million daily actives and remains on track to become the leader in its category.
Meta is squeezing more money out of every ad, even in a weaker economy. Rising impressions plus rising prices means advertisers still need Meta. That's real pricing power.
In Q3, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by engagement and user growth, particularly on video surfaces. The average price per ad increased 10% year over year, benefiting from increased advertiser demand, largely driven by improved ad performance.
Reels is now a $50 billion per year engine, proving that Meta's short-form video bet is scaling like crazy. A content format printing that much money gives Meta a second revenue pillar beyond the feed.
Reels now has an annual run rate of over $50 billion.
WhatsApp paid messaging revenue is up 60% year over year, proving that Meta can monetize messaging at global scale. It gives Meta a powerful third revenue stream outside of ads, something that Wall Street has wanted to see for years.
Including with click-to-WhatsApp ads, which grew revenue 60% year over year in Q3.
This is what everyone is missing. Even with all the AI spending, Meta is generating margins that most companies can only dream of. A 40% margin proves that Meta is so cost efficient, they can absorb huge AI investment without breaking stride.
Third quarter operating income was $20.5 billion, representing a 40% operating margin.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year-end, Meta had almost $44 billion of cash, and if we add marketable securities, it is over $79 billion. Cash and short-term investments at the end of 3Q was $46 billion, and Meta was net cash, meaning cash is greater than debt, by over $17 billion. This gives the company a ton of money to invest in the future, whether it is AI, data centers, the metaverse, or share repurchases. PP&E has nearly quadrupled over the last 5 years, and it is projected to quadruple again by the end of our model. In early 2024, PP&E was growing in the high teens, and now with massive AI investment, it is growing over 40% year over year. Meta has planned $70 to $72 billion of CAPEX in 2025, nearly double what they spent last year. Needless to say, AI infrastructure build-out is not cheap. While the company paid its first ever dividend in 2024, retained earnings increased by 19.5% to over almost $102 billion. While this is less than 2Q25, that's mostly due to share repurchases. To continue to grow retained earnings despite billions in dividends and share repurchases, along with increased AI investments, is remarkable. So what's the takeaway? Meta has tons of cash, its debt is under control, and despite huge investments in AI, it is returning billions of dollars to shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Meta generated a massive $164.5 billion in revenue, with nearly 98% coming from advertising. Revenue growth was almost 22%, the highest level in 3 years. And year-over-year revenue growth was over 26%, and it's been increasing every quarter in 2025. Since 2021, Meta's margins have been expanding. This is due to the tremendous cost discipline that Meta has been showing. Meta achieved net income of $62.4 billion in 2024, more than the last 2 years combined. While it appears that there was a big decrease in 3Q25, it was due to a one-time non-cash tax charge of $15.93 billion. Excluding that non-cash tax charge, LTM net income was over $74 billion, and it is growing rapidly. So what's the takeaway? High revenue growth combined with cost cutting means expanding margins, increasing profits, and more money returned to investors. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Meta is generating. While we see the increase in CAPEX to fund metaverse investments and AI initiatives, there is something amazing going on here. First, we still see an increase in free cash flow. But also, marketable securities generated $15.8 billion in 2024, a more than 2.5x increase from 2023. And in the first 9 months of 2025, Meta has generated almost $24 billion. Meta is generating billions from the more than $34 billion of cash that it has invested in marketable securities. Financing cash flow is negative, but that is not primarily due to paying down debt. What is fascinating is that the bulk of the outflow is due to the massive amount of cash being returned to shareholders. $35 billion was returned to shareholders via dividends and share repurchases. That trend has continued with over $30 billion returned to shareholders in the first 9 months of 2025. So what's the takeaway? With over $46 billion in cash and short-term investments, Meta is using those assets to generate income, which it's returning to shareholders and reinvesting in its business for the long term. So what do I think about Meta and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $2.25 trillion. We divide by the current shares outstanding. We get an implied share price of about $8.93. Compared to the recent close of $633.61, that's a 41% discount, which is a screaming buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. Stick around because I'll give you my thoughts on how to play Meta stock later in the video. Also, feel free to come to my live stream every Monday at 7 p.m. Eastern, where I'll answer your questions on this video or anything else. The link is in the description. So what does Wall Street have to say about Meta? Let's cover that next. While Wall Street is cautious about the massive CAPEX spend from Meta, the consensus is that Meta is still a buy rating. BNP started coverage on Meta with an outperform rating and an $800 price target. They believe heavy AI CAPEX can be monetized over time despite near-term margin pressure, and they argue that Meta's scale lets it convert AI into higher ad yield while self-funding the build with cash flow. Cantor Fitzgerald has a buy rating on Meta, and they lowered their price target to $720 from $830 due to heavier 2026 AI and cloud spend. They kept an overweight rating on the durability of the ad engine and engagement trends, and they see operating leverage returning as the AI infrastructure cycle normalizes. Wedbush has an outperform rating on Meta with a price target of $920, and they added Meta to their best ideas list. Wedbush cited ads momentum and Meta's aggressive AI roadmap as a buy setup amidst the pullback. They point to Llama, AI agents, and on-platform commerce as multi-year growth vectors the market is underpricing. CapIQ gives me a sense of how other analysts on Wall Street view the company. 60 analysts cover Meta on Wall Street. The range is from a low of 685, which is an 8% increase, to a high of 1,117, which is a 76% increase. The median is 850, which is a 34% increase. The overall rating on a scale of 1 to 5 is 1.38, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do have a position in Meta. It's currently a 4.4% weight of my overall portfolio. I was able to buy shares under 500 in mid-April during the tariff craziness, and I bought more in the recent pullback after the 3Q25 results. If you decide to buy Meta, I'll tell you exactly how to build a position, which I'll reveal shortly. The $27 billion Hyperion data center in Louisiana is structured via a joint venture with Blue Owl, and Meta will lease the campus. Could this be a unique way that Meta will fund these massive data centers?
Going forward, the construction costs of the data center will not be recorded in CAPEX. As the data center is constructed, we will contribute 20% of the remaining construction costs required, which is in line with our ownership stake. and those will be recorded as other investing cash flows.
Meta started building a $1 billion plus AI-focused data center campus in Wisconsin, powered entirely by clean energy. Meta is locking in long-term AI power by building the physical infrastructure its rivals will struggle to match. Meta is negotiating to move major AI workloads onto Google's TPU chips instead of NVIDIA's GPUs. Unlike NVIDIA, Google has its own large language model, Gemini, which Meta can now leverage with AI chip development.
So these would be TPUs, apparently, Tom, as opposed to NVIDIA's GPUs. How are they different? Are they better for the likes of inferencing, for example?
Yeah, so they were developed in-house by Alphabet, the parent company of Google, about 10 years ago, and they have since been adapted, and they can continue to be adapted because, of course, Google, as well as having its own chips, also has its own large language model, Gemini, of course. So there's this feedback loop between how the model performs. Then the developers can take that to the engineers of the chip and adjust the chip to add in those performance changes that they may need.
Meta hit an all-time high of $796.25 in mid-August, and it's down over 20% since then. My model shows a value of $893, which is a 41% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Meta is a buy at current levels. If you're interested in buying Meta, anywhere below 740 puts it at a 20% discount. If you decide to add Meta to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you can dollar cost average into the position. Meta is the only diversified pure play social media company out there, and their integration of AI into advertising is next level. Add in the potential for targeted advertising and AI data centers. Meta will be one of the big winners in AI. If you like this and want to see another in-depth stock valuation, check out my SoundHound video here or my Celsius video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.